When it comes to trust and probate loans, we know pricing can be confusing and sometimes frustrating. Many clients come to us after receiving misinformation from other lenders or being told partial truths about costs. Today, I want to pull back the curtain and explain exactly how our pricing works, when it makes financial sense to use our services, and why sometimes we might even tell you that our loans are not right for you. First, let's clarify the two main types of loans that we handle. Trust loans. These are primarily used for Proposition 19 situations when you're buying out beneficiaries and trying to preserve a parent's low property tax base. And secondly, probate loans. Besides for the purposes of Proposition 19, probate loans can be used for paying probate expenses, preventing foreclosure, or similar urgent needs. Let's talk about what actually determines the cost of these loans. One factor is the loan term. Our trust and estate loans are typically short-term loans at a higher interest rate in comparison to traditional mortgages. Secondly, property value. This will determine the amount needed to equalize distributions, and this affects your loan size and therefore cost. Third, urgency. Foreclosure prevention loans may have a different pricing due to their rush nature. Total cost of the loan is determined by the amount borrowed. Immediate cash paybacks. We have the ability to waive certain fees to lower the cost of the loan should you be in the position to pay back the short-term trust or estate loan relatively quick. Here's where our approach differs from others, and it's important you understand this. We often use a two-loan strategy. The first step is the initial trust or estate loan. This is admittedly more expensive than traditional financing. Let's just be transparent about that. Trust and estate loans are typically at a higher interest rate than your traditional mortgage because they're not designed to be held long-term. And this is the loan that goes directly to the trust or estate, not to you individually. Conventional refinance is the second step. After the trust loan distributes assets, you'll typically refinance the short-term trust or estate loan into a much more affordable conventional loan, such as a 30 or 15-year fixed at a lower interest rate. This two-step process is crucial because using your personal funds or getting a regular mortgage directly would trigger a property tax reassessment, potentially increasing your annual taxes by thousands annually. Let me give you a concrete example of a trust loan for Proposition 19 purposes. Let's say you and your 3 siblings inherit your parents' home and there is little or no cash in the trust. You want to keep the property and they want to sell. Let's say the property is worth $1.5 million, meaning each sibling's share is $500,000. You will need a $1 million trust loan to correctly buy out your siblings and preserve that low property tax base. The trust loan is only held for approximately 30 days. So once the property is transferred out of the trust and in your individual name, you will then refinance the short-term trust loan into a conventional loan such as a 15 or 30-year fixed mortgage at a much lower interest rate than the trust loan. This preserves the property tax base, saving potentially $14,000 to $16,000 annually. Unlike many lenders who just want to close a deal, we believe in full transparency about when our services don't make financial sense. If you can't qualify for the long-term financing, we won't proceed with the initial trust or estate loan. As well as if the long-term payment isn't affordable for your situation, we'll advise that you consider selling the property. We analyze your complete financial picture before recommending any loan. A key service we provide at no additional charge is our comprehensive cost-benefit analysis. We'll show the break-even point for the cost of the loan versus the annual property tax savings. We also will show a sell versus keep comparison to determine how much more each beneficiary will receive by allowing someone to keep the property versus selling it on the open market. This analysis often convinces reluctant family members who initially wanted to sell. We compare both short-term and long-term financial implications. Our pricing reflects several unique values we provide. Special knowledge. We understand the specific requirements of different counties' assessors, knowledge that most attorneys may encounter once or twice a year. We run into this every day. Family mediation. We help resolve conflicts between beneficiaries with objective financial analysis. Fast funding. We can provide funding quickly to prevent foreclosure or other urgent situations. These loans are at a higher upfront cost due to the fact they are not designed to be held long-term. Complete education. Unlike other lenders who just quote rates, we provide a full financial education so you can make informed decisions on what's best for you. The next step is simple. Reach out to us for a personalized analysis of your specific situation. We'll need to understand the following: your family's specific situation and dynamics, the property address, your long-term goals for the property, and your personal financial situation to ensure long-term affordability. Our goal isn't just to provide a loan. It's to help you make the right decision for your family and financial future, even if that means not using our services. Because at the end of the day, what matters most is hearing that sigh of relief when you realize there's a solution that works for you and your family.